The Fed is lowering rates, but long-term rates, they aren't following suit. Just check out this chart. This is the 30-year bond yield, graphed against the 3-month bond yield. The 3-month bond yield, it's effectively tied to the Fed fund rate, which means when the Fed lowers interest rates, the 3-month yield goes down. And traditionally, the 30-year bond yield will follow, except in certain circumstances, like when the markets, other countries, or what's called bond vigilantes disagree with the direction of interest rates. And what you're seeing right now, represented by this green line on the bottom of the screen, is an increase in the difference between 30-year and 3-month bond yields. And when the difference between these two rates starts to grow, it's usually not a good thing for the economy. In fact, when you go back through recent history and you look at the difference between these two interest rates, it becomes abundantly clear that a significant increase in the difference between those rates is quite often followed by a recession. You can see it back here in the 1990s, again in the early 2000s, right around the time of the dot-com bubble bursting. You can see it again here in 2008 and prior to COVID. But the question is, who's responsible for the 30-year rates going up? And how does that affect the US economy? But the scary thing here is this difference in interest rates between what the Fed is doing and what the bond market is doing. It's a sign that certain players in the bond market believe that the economy is not getting better. They believe that inflation is still a risk. And they believe that the direction that the Fed is headed is not the right one. And what's crazy about this is it's all happening at the exact same time that Donald Trump is pretty much insisting that the Fed lower rates further. But clearly the markets disagree with this idea. So I'm going to show you the mechanism here, what's actually happening. And I'm going to show you the real risk for the US government when it comes to these higher bond yields. And I'm also going to show you why Europe may become the biggest threat to the US economy, not because of new trade alliances or retaliatory tariffs, but because of their substantial bond holdings and how they could use their bond holdings in order to crush the American economy and potentially the world's strongest superpower. Now, I've seen a lot of debate back and forth recently about who's responsible for higher bond yields. In some cases, people are assigning the blame to what's called bond vigilantes. These are massive players in the global bond market who use their massive positions to protest against monetary or fiscal policies that are considered inflationary. And they do this by selling bonds, basically offloading the bonds, decreasing the price, and thus increasing the yields that come with those bonds. And in modern history, it's been argued that bond vigilantes, they can essentially affect the markets. But it's also been argued that these vigilantes, well, they aren't necessarily coordinating their efforts. It's actually more of an uncoordinated reaction to economic policy that bond players just happen to agree upon. And it's important to understand the mechanics here, because basically when it looks like policies are going to be inflationary or there's going to be uncertainty, people who hold bonds or big organizations like hedge funds that hold bonds, they have to assess whether holding those bonds and getting a low rate of return is worth the risk associated with actually having them. So in a lot of cases, these massive drops in the bond market, they aren't so much about coordinating to fight against the Fed. They're more about uncertainty in the market and not wanting to hold something that could go down in value significantly if they continue to hold it in their portfolios. But there's another type of bond vigilante that can rear its ugly head in the form of foreign nations. And this is where the real power lies in the bond market. And at this moment, as the Fed comes off a rate reduction, and it looks like they're headed towards more in 2026, although not in the near future, you're seeing this rise in interest rates, this offloading of bonds out of portfolios and selling them for pennies on the dollar. Well, maybe not pennies on the dollar, but cheaper than what they should be sold for. And some might argue that this could be foreign governments, because recently there was a lot of controversy around a big block of ice called Greenland in the Atlantic Ocean. And this led to a standoff. And it became very clear very quickly that Europe wasn't going to stand for this. They weren't going to hand over Greenland to appease the US president. So President Trump, he did what Trump does. He reacted to this using his favorite weapon. He announced a 10% tariff on goods from Denmark, Norway, Sweden, France. France is an interesting one because he also threatened to tariff the wine industry by up to 200%. And then Germany and the UK, as well as the Netherlands and Finland. And he said this would go into force on February 1st. But he didn't stop there. He threatened that it could rise up to 25% if a deal wasn't made. In other words, he threatened an ally in order to get something that wasn't his. And at this point, Europe, well, they finally decided to fight back because it's become clear that a partner that's irrational and unpredictable might not be the best partner at all. And we saw this recently with Canada going to China and striking a trade deal in order to lessen their reliance on the US. And Mark Carney, the Prime Minister of Canada, literally cited the fact that China is a more reliable trade partner than the US, which can be seen as nothing else than a shift in global politics. And in a very short period of time, Europe was able to get Trump to back off. They essentially took the position of, we're not going to be bullied. We will bully back. And it turns out that they had a bunch of tools in their toolbox, including their substantial holdings of US bonds. And at this point, it's becoming highly likely that one of the primary sellers of those bonds that's putting the US in a tougher and tougher financial position by having long-term rates increase could very well have been Europe. And part of the decision to back off on the tariffs and back off on the outright sale of Greenland could very well have been the $10 trillion of US assets that European countries hold. And if sold at fire sale prices, could have had a significant impact on long-term interest rates in the United States and subsequently increased the cost to service the US's insanely high debt, putting the US in a similar position to what the UK found itself in the 1950s, where all of a sudden it went from a global superpower to a country that needed a bailout, allowing the US to insert itself into the conflict and basically take over power. You see, it wasn't a war or a battlefield that the UK lost its power on. It was in its balance sheet. And right now, it seems as though the US's balance sheet is actually becoming something that other countries can weaponize in order to minimize its power around the world. Because when you start to look at the US's foreign debt, just the blue area is about $10 trillion worth of the US's debt. These are bonds and treasuries that are held by foreign nations, and Europe is by far the biggest holder. And then when you combine them with Canada and the Cayman Islands and Brazil and other Latin American countries, you start to see that a large majority of the US debt that is held by foreign nations is actually held in America and Europe, meaning that these countries may not be able to fight off the US in a pure trade war. However, they do hold some leverage in the form of bonds. And that leverage allows them to ultimately act as bond vigilantes and affect long-term interest rates in the United States. And this allows them to effectively play with the yield curve. The yield curve is the difference between long-term rates and short-term rates. And when that yield curve, the difference between those rates, is starting to get higher, it is quite often an indicator that a recession is around the way. Well, what if other countries, foreign nations, could mess around with the bond yields in the United States and ultimately induce one of these recessions, making things like mortgages and loans more expensive, while the Fed lowers interest rates, which causes inflation, which creates this squeeze because everything's more expensive from a borrowing perspective, and inflation starts to rise, and all of a sudden there's less money to go around, inducing a correction or a recession. That, at least in my opinion, is the real game that Europe was playing here. It was no longer about trade. It was, hey, look at what we can do with your 10 and 30-year rates and come back to the table with a little bit more grace next time because you underestimate the leverage that we actually have. Because ultimately, here's the real problem. The real problem is this. You've got national debt skyrocketing, especially since 2020. Now, this didn't seem like it was a problem until such time as we started to see interest rates go up. And if foreign nations are able to leverage their US debt holdings and cause interest rates to rise, that increases the cost for the US to service that debt, meaning that the national debt, which is already insanely high, could become even higher because the interest costs in order to service it go up substantially, making the debt problem even worse. And when you look at the cost to service US debt, you can see very clearly it has gone up and up and up and up over the years. And we're not even a month into 2026, and it's already approaching more than a quarter of what it was in 2025. And if interest rates go up, this gets worse. Now, that's not to say that there's all bad news out there, because I have seen charts like this floating around. Ones that show the amount of US treasuries and bonds that are coming up for renewal this year. But this actually isn't as alarming as the difference between short-term and long-term interest rates, because what this shows is normal. This is by design. The US is always issuing more shorter-term treasuries and bonds than they are longer-term ones, which means that almost all the time, there's going to be more bonds renewing next year than there is in the ones that are following. So this isn't a scary stat or a scary number. And to prove it, you can see that the large amount of US bonds that are issued, and in this case, I'm using the words bonds and treasuries interchangeably, but they're issued with a term that is less than 52 weeks. This is why it's almost always the case that the number of bonds and the number of treasuries that are coming up for maturity in the next year is going to be higher than at any other time. And the US will simply just reissue more treasuries. But here's where the problem lies, is when they issue those treasuries, in order to get other nations and buyers to buy them, they have to offer higher and higher yields. And those higher and higher yields mean higher interest costs, and that means more debt. And this is where that US total debt could get completely out of control if other nations decide to use their bond holdings as leverage against the United States. So tariffs, they might disrupt trade and change the balance of trade with the foreign nations that they're placed upon. But those tariffs, they will never outweigh the rising interest cost, which means Trump's been over here playing a game with respect to tariffs that the other countries didn't really want to play. And up until this point, they hadn't really pulled their trump card, but now they have. At least it seems that way. And the more the US isolates, and the more the US realizes that other countries have leverage against it, not just their treasury holdings, but also their ability to form new alliances, the isolation of the United States is becoming more and more dangerous. And what makes this even scarier is when you look at the Conference Board's leading economic indicators, well, the US has been bouncing around and on the precipice of a recession going back to 2022. It hasn't happened yet, but if the US isn't careful, and bond yields continue to rise, even in the face of the Fed lowering interest rates, a recession could be triggered at pretty much any point. And while I wouldn't put my money on a recession happening anytime soon, because as you can see, the LEI has been incorrect for the first time in a long time for basically the last 2 to 3 years, I wouldn't bet my money against it either. So the question is, what does this mean for you? Well, first and foremost, diversification is key right now. Just because the stock market is at an all-time high, and silver's at an all-time high, and gold's at an all-time high, it doesn't mean you should be invested in any of those things, at least not fully. And your biggest risk is being invested in only one thing without diversification. I'll point you to the Ray Dalio all-weather portfolio, which hasn't performed well over the last few years because of its bond holdings, but that is an example of a diversified portfolio that can withstand a change in economic circumstances far better than gold, silver, or the S&P 500 alone. But most importantly, if all of this stuff that could trigger a recession actually does, the most important thing you can do right now, while things are still okay, is get rid of as much debt as possible, make sure you aren't over-leveraged, and make sure that all of your money isn't invested in one single asset that, if it falls, could take your entire net worth with it. Because at the end of the day, all the uncertainty in the market, what's going on with bond yields, what's going on with the stock market and gold hitting all-time highs, this is an indicator that things could turn on a dime. It doesn't mean that they will, but they could, which is why being smart financially right now has never been more important. Oh, and if you want to see what always happens before a financial crisis, what could happen if things go the wrong way real quickly, make sure you check out this video right here.